Today we have Omen Quelvog from Formynder Wealth Management joining us today to talk about a topic that I think a lot of people feel like they have a really good handle on, but honestly, I don't think we can review it enough. And that is a deeper dive into the TSP investments that are available. So the core funds, as well as the lifecycle funds, and then how you put those together. So super excited to jump in with Omen.
Thanks, Amy. Looking forward to it.
Welcome to Operation Retirement Readiness, where Amy and Mike, two certified financial planners, talk about how military members can prepare for transition and how veterans can prepare for ultimate retirement. This podcast represents the views of the hosts and any guest. It is for informational purposes only and should not be considered tax, financial, or legal advice. All information is regarded to be from reliable sources. The hosts are not responsible for any losses, damages, or liabilities that may arise from the use of this podcast. This podcast is not intended to replace professional advice.
Welcome back, everybody. Thanks for joining us today. We've got a special guest, Omen Quelvog from Formynder Wealth Management. As we said in the intro, we're going to be talking about the Thrift Savings Plan and really drilling down kind of into individual investment choices that are available within the TSP and why you might want to consider them and how you build your asset allocation. So welcome, Omen, and mind just giving us a little background on yourself?
Yeah. Thanks, Mike. Thanks, Amy. So I retired from the Marine Corps in 2024, so not too far away. And I knew before I retired that I wanted to get into the financial profession. I just didn't know exactly what I wanted to do. So through a skill bridge with the Military Financial Advisors Association, was able to kind of whittle that down to something that I felt was most beneficial to my life in the way that I wanted to enjoy my life post-military retirement. And helping others through their finances was the way to do it. And so I've had some great examples like both of your firms and quite a few others actually, to just help me open up my own firm, and did that just last May. So I haven't even had a year of business under my belt yet, but have been loving it so far. So it's been a really great experience.
Can you share the name of your firm and how you came up with that name? Because I think it's pretty cool. It's a story worth telling here.
Sure. So when I originally wanted the name, I wanted something to do with Guardian. So my firm is a faith-based firm, but also it's as far as Guardian goes, like I wanted people to have trust. But you can imagine like Guardian in a financial planning firm, wealth management firm is fairly popular. And so I threw this over to my family, and my sister said, well, why don't we just kind of bring our heritage into this, and let's take a look at the Norwegian translation for Guardian, and it was Formynder. And so I said, oh man, that just rolls off the tongue. So I said, winner, winner, chicken dinner, you are it. And that is the name. So yeah, so it's the call sign of the very first unit that I was assigned to in Yuma, Arizona, Guardian. And then, also bringing a little bit of heritage into it as well.
Yeah, I love it. And it's not here, but probably in the show notes, a link to your firm with the logo. Pretty cool. I think your wife designed it, right?
Yeah, my wife designed the logo as well. So yeah.
Yeah.
Full family affair.
Yeah.
Nice.
Yeah. Well, being in business is a team sport. So I think everybody knows. But to jump in, like Mike said, we want to dive into TSP investment options. And listeners might be thinking, oh, we've been over this a million times, but it cannot hurt to go over it again. There are changes that happen. We had a change last year. And then just, how people think about putting portfolios together. And the value of having a third financial planner in here is that we get a third perspective on how to do it. So with that, Omen, how about if you just give us an overview of the funds that are available in TSP?
Sure. Yeah. So core funds, right, is CSI, F, and G. Right, that's the way. Your 5 core funds. And those core funds, I think, in my opinion, make things rather easy, which is why people enjoy the TSP so much, is because when we tell you to diversify your funds, you can do diversification with those 5 core funds is super easy to do. In addition, you've got your L funds, your Lifecycle funds, which basically every 5 years, pardon me, every 5 years, one closes and one opens up. And then this past year, right, we had a brand new Lifecycle fund open up, and we had one that retired. And so for me, the way that I look at this, for the most part, generalized, is I kind of separate these two things out. Is you've got your 5 core funds, but you've got your Lifecycle funds. And the reason I separate those two out is because the Lifecycle funds are made up of the core funds. And so I'm sure we'll talk through this a little bit later about which ones are better or worse, or how would you combine these. But that's, for the most part, that's it. I mean, TSP keeps things rather simple.
Yeah, you hear people complain about that, but again, you can create a diversified portfolio, which is what, most financial advisors preach is, hey, don't put all your eggs in one basket. And you can get a good portfolio based on that. Can you get every little thing and every tweak? No. But for the core of your portfolio, I find TSP to be, fully adequate. So, so let's dive into the 5 individual funds and just kind of talk through so people can understand what, when I get the C fund, what am I getting? So, why don't we start with C?
Yeah. So C fund, right, is the equivalent of your large cap S&P 500. We have, and I think we have to say this, that this is not a specific investment advice. We're not telling you to go do this thing, but right. So SPY is a common ticker symbol for an equivalent of what you might get if you were to do the same thing in the civilian spaces in a Fidelity or Vanguard or Schwab account or something like that, right? Is you get that large cap weighted investment.
Yeah, that exactly. And again, 500 largest companies,
That's
U.S. companies, and it's been on a tear the last, I don't know, 5-10 years. So performed really well. But again, it's those 500 companies based on the their overall size. So heavily weighted to really like the top 10, top 15 names in there. So pretty concentrated, especially right now. And then, okay. Go on, Amy.
No, I was just going to say, I think a lot of people think of C fund as sort of the bread and butter, right? Even if you're building your portfolio on the outside, you probably have something that is S&P 500 or S&P 500-esque, or you have the components of it just in a different wrapper called a different thing with a different expense ratio. So if we call that the bread and butter, then I think, the next fund to maybe talk about is the S fund. Because it brings in a little bit different piece of the U.S. market. Can you talk about the S fund a little bit?
Yeah. So S fund, your small cap equivalent, right? It presents a little bit more risk for a potential reward. So the equivalent ticker proxy on the outside, and I'd be curious your thoughts on this one too, but you have USMIX. Have you heard of that one?
That's not the one I used, but
which one do you use, Amy?
I use IWM, which is the Russell 2000.
Gotcha.
Yeah.
There's no exact proxy, but there's several that folks use, and they're all probably good enough type thing to what's on the outside, but.
I think when we talk about the proxies, at least the way that I think about it is the behavior. We're trying to track the behavior of this particular investment on what it might do on the outside. And so for a small cap, for me, I would expect this to be a bit more risky, I should say, a little bit more standard deviation movement, and that. But the potential for reward in that is also likely to be a little bit larger. Yeah, I don't know if there's anything else on that you wanted to.
Yeah, I
Yeah,
mean,
it's
how do
just
you
the smaller. Oh,
yeah. And how do you think about, I mean, I guess we'll get into this in a little bit more detail after we cover everything, but adds risk, potential reward. So it might be, something that perhaps younger people are using in their portfolios, right?
Yeah, when we talk through putting together the entire asset allocation, right, of your CSI F and G funds, right? You talked about the bread and butter of the C fund being kind of that's going to sit nice and big at the base of your allocation. But, for somebody who's not going to retire for the next 20, 30, 40, even 50 years, I mean, you think about an 18, 19, 20-year-old coming in, we're not talking about military retirement. We're talking about work optional retirement when you don't have to work anymore. And now this is when you're starting to take that money. You've got a lot of time. I mean, just think about what has happened in the last 30, 40, 50 years for the three of us, right? We've had COVID, we've had the housing market, we've had the tech.com bubble, we've had, 1987. We've had a few things. And so that is, we've seen several times where the market has had some significant negative impacts, where if you would have held a significant portion of the S fund during those times, you would have probably seen a significant downside in your portfolio. However, we've also seen the market recover from that quite nicely. And so you've got time. So when you're talking about the specific allocation of S fund, it really depends on how much gray hair you have, probably. Not me or Mike included in this. I'm not taking
yeah.
this like we're definitely still young enough to have S fund, but it really kind of depends on your time frame about how much S fund you have.
All right, and then the I fund.
I for international, right? Not in the Navy sense here. So this one is, and you guys pointed out some things to me that were news to me in terms of the addition of emerging, but this is the International Market Fund. We have seen in the last year, the international market has done quite well. And I think for the most part, most advisors that I know have always encouraged, and I use always loosely, but always encouraged some amount of international, right? The US, despite what we might think, is only 2/3 of the market. And so if you are isolating yourself and your investments to just what the US is doing, you are missing out potentially on some global diversification and what other markets are doing. And so, we noted a couple of different things in the notes that we were prior to us starting our recording here about emerging markets. So I think I'd be curious your thoughts on the addition of emerging markets, but for me, I consider that to be more diversification. It's something that I actually use in my own client investment portfolios. Is not a lot, but some diversification into emerging markets. So I'm glad to see that in the iFund, but no shock, I don't think, for those in the military that ex-China, right? Like, I don't know. Mike and Amy, I kind of know your backgrounds in the military. In many of the spaces that I worked in as well, China is definitely a factor in several different areas of our lives. Perhaps we might not want to be investing in Chinese investments. So not really a shock there, I don't think.
Yeah. Yeah. I mean, and of course there's actual laws on the books at this point
Yeah.
on, what we can invest in terms of China. So it shouldn't surprise anyone that, yes, they added emerging markets, which I think is a very favorable thing.
Yes.
Emerging markets are, think of those as the small cap of the entire world, ex-US. So finally TSP updated to an index that tracks all developed markets, ex-China, ex-Hong Kong, but it also includes emerging markets. I think that's a really big win
Yes.
for TSP participants.
Yep.
All right.
Now, one other thing I'll add is, it's interesting. So for years and years, so I've been in the industry since 2019. And since 2019, even when I was at a different firm, a lot of clients underweight international, and having a discussion with them to try and get them to add international was difficult. Why would I do that? Well, last year is a good reason for
Yeah.
why you do that. You don't know when you're going to get years like that. Does it mean that's going to continue? Nope. But it also doesn't mean that, if the US has a correction, for example, it doesn't mean that international will have a correction as well. And that's the value of diversification that you were just talking about with S Fund. Um, Now let's jump over to F Fund, because I think that's kind of, a fairly standard run of the mill, easy to figure, easy to find something on the outside that acts like that. Tell us about F Fund and how your clients and people you talk to feel about F Fund.
Yeah. So F Fund, now we're moving into fixed income, right? So the equivalent on the outside world is probably something along the lines of the ticker AGG, right? And so when it comes to the F Fund and even the G Fund for that matter, fixed income is certainly a portion of most of my clients' portfolios, but to the certain extent of most of the people that we're talking to in the military who are actively contributing to their TSP, or even in the federal government for that matter, if they have access to the TSP, the amount of fixed income that they have in their portfolio is likely not to be significant, right? I mean, we're talking 10, 20, maybe 30% or so. So, when it comes to the F Fund, it's certainly better than the G Fund. And I have heard some stories back in the day when the default was the G Fund. Like when you made your contributions, the default was to the G Fund, and people didn't know that. And they get to the end of their 20-year career and they had hundreds of thousands of dollars in the G Fund. That's unbelievable to me. But that aside,
I just had somebody come in last week that they yes, luckily they were investing outside also, so their overall allocation was not, horribly skewed, but it was, the TSP was 100% G.
yikes.
And getting ready to hit 30 years and retire.
Oh, that is painful. But, and we're always thankful for the G Fund and even the F Fund in certain cases in years like 2022, right? But they are very specific years and they're very sparse, right? They're dispersed out over the time. So there's not a lot of growth opportunities there. Again, I think that there's some portion of most people's allocation that, depending on how much time they have left till they need the funds, would be well suited for the F Fund. But for the most part, when we're talking about young military folks, perhaps not.
Yeah.
And overall,
ahead,
just a standard kind of bond fund, bond index across, all types of bonds, and, intermediate. If you're familiar with bonds, it's typically, a intermediate time frame when these bonds will mature. So typically the 7 to 10 year range, for folks who maybe are a little more technical and on the bond side. But yeah, it just means they've holding short-term stuff, they're holding long-term stuff, and it just kind of averages out to that intermediate time frame for bonds and what you can expect.
Yeah.
And one thing, so what I find with folks is, there are people who are more conservative, especially as they're getting closer to their retirement. And I work with a lot of federal employees as well as military. So on the federal employee side, there tends to be some conservative folks there. They have a preference towards G Fund, shockingly. But because in their view, because in the near term, if you look in the recent past, G fund has outperformed F fund. But that's because in 2022, there was such a big, basically a bond implosion, if you will, to a degree. Now, here's the thing, right? So the argument against F fund and even G fund is that it's boring. Well, the older you get, the more you will appreciate boring.
Yes.
So I like to tell people there should always be one part of your portfolio you really hate. And if it's bonds, that's fine. But there might be a time when you appreciate those bonds.
I used to like mowing my lawn too. I'm starting not to, right?
Yeah. Yep.
So
times changed.
Times do change. And Mike, one thing you said that brought up a thought on the F fund, right? If people in the outside world are a little bit concerned, or they really don't want to think about, I need to buy this short-term bond or this intermediate term bond or this long-term bond, and now I'm trying to figure out this bond ladder and when do things, they mature, and then I got to figure out how to reinvest it and all these other things. The easiest thing to do at that point is just get into a bond fund, right? And so the F fund actually kind of makes that easy when you think about it.
Yeah, 100%.
So let's talk now about the G fund. So the G fund is a little unique. Omen, can you just kind of talk about what makes it unique?
Yeah, there isn't an equivalent for this in the civilian spaces. Like, there's no proxy that you can track. And the uniqueness of the G fund comes in its tie to the average of the U.S. Treasury rate, which we consider as the risk-free rate. So this fund itself is considered a stable value fund. And so for somebody getting closer to the retirement who wants something a little bit more stable, the G fund is it. Like, this is quite literally the fund that we want to start putting people into as they get older.
Yeah, I mean, it's again, the challenge is when folks, think that they will need to be in that when they're in their 20s and 30s. But it's great. Again, similar to cash, similar to a money market. I mean, that's the equivalent. You can start thinking about this as, your bank paying interest, high yield savings account. That's the range of returns you're going to get, maybe a little bit better type thing. But it's really that bedrock of investments that, hey, I'm retiring next year and I know I'm going to need, $50,000 in spending. I don't want that in the C or the S fund because,
right.
Hey, we don't know if it's going to be down 25%. Hey, I'm going to put this money that I know I'm going to spend in the next 1-2 years in the G fund, so I know it's going to be there. And then when I need to take those distributions, I'm just pulling that money, out of that fund. Appreciate you giving us a rundown on all the different funds, the individual core components. As we talked about a little earlier, there's also the Lifecycle fund. So why don't we dive into those and just talk through what those are, and then how you go about potentially using them if you decide that that's what's right for you. So and you gave us a little bit of an overview, but you want to go a little bit deeper on
Sure.
the L funds again?
Yeah. So I guess first and foremost, I'm a man of simplicity. Just because if things are too complex, like, they'll just go over my head and I'll forget about it and all these other things, right? So I consider the L funds to be the easy button. Like, it has all 5 core funds within it. And if you don't know anything else, the military itself is going to help you out. I mean, we've had some recent changes in the way that the government now invests you into the most appropriate L fund to you when you enter the service. That's fantastic. And if that's all you ever do, you can't go wrong. Like, this is going to be an amazing journey for you. So if you don't have a lot of investing knowledge, or you really just don't want to be in charge, I guess, of how you're allocated out, the L fund's just do it for you, right? You've got all 5 core funds in there, and the farther out you are, what are we on right now? I think L2070 is
2075 was the new one that just
2075.
launched.
Okay, 2070. Oh my gosh, 2075. Oh, how young are the people getting into the service right now? Anyway,
Yeah.
so 2075. All the allocations that we just kind of alluded to when we talk about C, S, and I versus F and G funds, those are all taken into an account for how much risk you can take on as an individual who is 20 years old versus somebody who is 45 years old. And with the L fund, the work to allocate into heavy equities, so heavy S, C, S, and I funds early on to low fixed income F and G early on, there's a slope. As you move from 20 years old to 45 years old, if you stay in that same fund, it's just the trajectory will slope downward to less equities when you're 45 and more fixed income when you're 45. Between the 3 of us, we could talk all day on whether or not that slope is appropriate for somebody getting out of the military. But if you don't know anything about investing and it's just not something you want to think about, the L fund is for you because it adjusts that risk automatically.
Yeah, and just some numbers, pulled these up just before we got on. So like I said, the L2075 means, hey, I think that's about when I'm going to retire. Right now, that's starting out with 1% in the fixed income G&F funds and 99% in the C, S, and I. So very heavily weighted toward the equity side, like Omen talked about, and how that makes sense. You've got such a long time horizon. That's where you want your money. Then you look at 2045. So 20 years from now, you're getting ready to retire. That's shifted now. So over the 30 years to about 23% GNF funds and 77% CSNI, so the stock side. Finally, as you get even closer, 2030, you have 43% in the G and F funds and 57% in the CS&I funds. And then finally, there's a unique one. Eventually, as you pass, like Omen said, 2025 just went away last year because, hey, we hit 2025. You've transitioned into the income side, which the L income right now for those in retirement would be 72% on the GNF fund and 28% on the CS&I fund. So you go from 1% fixed income at 2075 to and then in the L income fund when you're fully retired, you go all the way up to 72%. So and the nice thing is, as Omen hit, this is all done behind the scenes for you, professionally managed. They're keeping the weightings correct, based on their models, and you don't have to worry about it.
Yeah. And I think one of the cool things about the L fund too is if you, let's say you enter the service today, you're in the L2075 fund, and 10, 15 years from now, you think, you know what, I think I'm not happy with where it's weighted at the moment. I'd rather mostly be still in equities, and I don't like the slope that there is. By the time we get there, there's a L2085 fund available. You can shift all your investment into that L2085 and continue to take more risk. And I think that's where the nuances that the 3 of us might talk about of, when somebody gets to the end of their military career, they actually still have probably quite a bit of time left before they, time horizon, I should say, before they would need that money. And so perhaps being so heavily weighted into fixed income might not be ideal, but you can always just move into a different L fund and get a different slope trajectory that is weighted more heavily into equities a little bit longer than your retirement from the military.
And I think that's a good place to, kind of start asking about, philosophy, right? So, like as you pointed out, this is not individual advice for anyone. We're not saying what to do. But I mean, when you have, let's say a client comes to you, um, they have 4 life cycle funds of differing years, and, 2 or 3 of the individual funds. And you go through the financial planning process with them. You understand their goals. You know when they need money. You know how old they are. Let's say these folks are in their mid-50s. How do you think about, sort of adjusting that portfolio for them? What's your philosophy? And there's 3 planners here, so you get 3 philosophies. But Omen, how about if you tell us about yours?
All right. So first I'll tell you that I've actually never seen, and granted, my firm is less than a year old, so I'm sure it's on the horizon somewhere, but I've never seen anybody with multiple L funds. What I usually see is an L fund and some portion dedicated to CS and I somewhere, maybe F and G, but like it's a combination of L fund and the core funds. That's what I usually see. So the very first thing that I'm thinking when I see something like that is, what is this person's understanding of how all of this works together? How, are they aware that this is really a risk-based analysis? And so that begins the conversation up front. We're going to go through what their investment risk profile looks like based on their tolerance, their capacity, and their need. But ultimately, I would prefer to begin with a little bit of education on that. And it's really understanding what they understand about why they are in those funds that they chose. And if there's no real good reason, because I think most Americans think this way of, well, if one is good, more is better. Like I'm just gonna shotgun blast this thing into every investment I possibly can, but understanding that the L funds is actually made up of those 5 core funds. That is the nuance where I think most clients like don't necessarily understand that when you say I want to just be 100% equities. So I'm going to be in the CS and I, but this L fund looks great. So I'm going to take this L fund as well. Like, well, you have now just added fixed income. Did you know that? And so just kind of talking through those things first. And then once I get an understanding of what their tolerance, capacity, and need is, and we've gone through a little bit of education to understand how comfortable they would be in moving from one fund to maybe a multiple of the others, or if they're just, I don't want to think about it, let's move you all into the L fund. Once we get that conversation out of the way, then we make those recommendations about what's most appropriate for them.
Gotcha.
Yeah, it's interesting when you're talking about, hey, what are they, what are they trying to do? I mean, if somebody comes in and goes, yeah, there's too much international, so I added some S to, because I wanted more small cap exposure. All right, great. If they go, well, somebody just told me that I should have some of this, or, I looked and this has done well the last couple of years, so I just, pushed in and kept the L. Yeah, it's definitely having that conversation and trying to understand. And then, it's also, one of the big things is looking across their whole portfolio if they've got stuff outside of TSP, and trying to create a logical and, well diversified, well balanced whole portfolio. It can be difficult to do, and really keep the clients on that path. So
yeah.
And rest assured, Omen, rest assured, you will see more than one L fund at some point. I've seen 5 in one TSP. I think that might be the record, but yeah, I've definitely seen 5 with some other individual. And like you said, it's good to have a conversation about why. Right. There was a reason that they did it, maybe because they didn't understand. So that's education, but maybe there's a deliberate reason why they did it. And a lot of times, It's because they wanted to take more risk, but they like the idea of the diversification as they take it. So they add the funds that are further out, um, which, that's great. But it makes it a little bit more difficult to manage the overall portfolio, to Mike's point. Um, Now, how do you think
And
about the life cycle funds in terms of glide path and, kind of setting clients up for the future? Do you really like using the life cycle funds? Do you use them situationally, or do you prefer to break them apart and just buy the underlying core funds?
If they are clients of mine, my preference is to break them out of the L fund and manage that because, Mike, you mentioned it as well. And I'll keep banging the drum on the fact that I'm a simple man, is that when you have it in the L fund now, and we'd be doing annual checks anyway, but now with that glide slope, your TSP fund is doing something throughout the year in terms of it starting to glide into more fixed income and less equities than what you have potentially have planned, right? You kind of have to look ahead and say, okay, this fund is here at the beginning of the year, and at the end of the year, it's meant to be there. So how do I account for that glide slope in the rest of the client's portfolio through taxable accounts, through retirement accounts, and make sure that overall they are taking a risk that is appropriate for them. But when you break it out of the L fund, then although you are still doing a rebalance, it's still a little bit more predictable, I should say, about where a client might be in terms of how much equity they have and how much fixed income they have in their total portfolio.
And so, kind of along the same lines, that was on, more on the client side. And yeah, that makes perfect sense when they're working with somebody. Let's do it for a listener who goes, hey, I do this on my own. Not, I don't have an advisor. I do want to keep this relatively easy. We've thrown around the glide path and increasing risk, decreasing risk. But can you talk some about, let's use a notional person, um, and why they may want to pick, L 2040 versus 2045 versus 2075 overall. Can you hit that?
Sure. So we don't want to Dave Ramsey this, right? Is that what you're saying? Okay, we're not going to do that. I like Dave Ramsey, but there are some nuances. Okay,
Yeah.
so I would say very first thing when we talk about whether or not you're going to be in the 2045 versus the 2040, we're talking optimization. The thing that if you choose one or the other, the very fact that you are investing into an L fund that's going to do some work for you in the future is goodness. Like, keep doing that. The nuances in a 2045 versus a 2040 versus a 2075, that really comes down to your understanding of your own risk. How often are you checking the TSP? How often are you watching the news? All of these, and how long is it till you need the money? Do you need the money? I mean, that's often a question with pensions. Like, do you even need the money? I don't know. So, it's for me, and if I were to just talk to anybody out on the street about how to think about which fund to take advantage of, especially if you're just talking the life cycle funds, it's really what's your understanding of how much risk you're willing to take. The farther out with the life cycle funds, the more risk you are taking. But you have the more potential for reward. I mean, they are linked. Just because you choose a 2040 40 fund or, even a 20-30 fund doesn't mean you're not taking risk. It's just the other way around, where if everything's in fixed income or a good portion of it is in fixed income, now I'm asking, well, are you keeping up with inflation? So like there's risk involved on either side of things. But generally speaking, for anybody who's listening and thinking, well, I do want kind of the easy button with the L fund, I think this just comes down to how much risk you're willing to take. How much time do you have before you actually need the money? Do you actually need the money? Things like that.
Yeah, I think that's key. When are you going to retire? When are you looking to start drawing from this? And that's kind of the date you want to potentially center on. So if you've got 20 years till ultimate retirement, 2045 is probably a good, starting point. And then go, I need to take a little more risk or something because, maybe you started late saving or something, but then maybe bump it up to the 2050 and you'll get a little bit more again on the stock CS&I funds and a little less in the G&F. But yeah, those are some great points. Is it's when you need the money, and also if you're willing to take a little more risk type thing, are really the two decisions you want to make, and then set it and forget it and really just keep plowing money in, and you're probably not going to go wrong with that. So
yeah.
And I do think it's key for some people to realize, the answer to the question of when do I need this money, the answer really might be never. If you're going to have a pension, you don't know that for sure. But it certainly isn't going to be the day you take off the uniform. In most cases. In some cases, of course it is, but maybe you should be saving in other accounts if it's the day you take off your uniform. But that's a whole other discussion. So Omen, as we wrap up, what else do you want people to know about the kind of crafting a portfolio using the core or L funds in TSP?
Probably really just not to overthink it. The mere fact that you are investing in TSP at all, so especially for our BRS, which is pretty much everybody, hopefully, that we're talking to at this point, I think we're getting there almost. And that is, get the match, but don't overthink this. If you're not comfortable with investing, think about the L funds. If you're more comfortable with investing, think about the core funds, the individual core funds, and how you might invest there. And, Mike, you brought up earlier somebody who is maybe invested in not only an L fund, but also some element of a core fund to deliberately change the percentages of, having more small cap or international or less or something like that. If you want to change that up, great. Just know that you're adding a little bit more complexity. You'll have to watch that a little bit more in terms of, as your L fund starts to change its percentages, you're going to have to change your core fund percentages and things like that. But ultimately, TSP is set up to be a very easy thing to do. There are some downsides to it being so easy, but for the most part, for the average investor, don't overthink this.
great advice. So Omen, if folks wanted to find out more about you or Formynder, where can they go?
Yeah. LinkedIn. So I am one of two Omen Quelvogs, if you can believe it. So I told my brother, don't name his son, my nephew, Omen. I said, don't do it. It's like a boy named Sue, right? He did it anyway. So great. So, but he's a teenager, so you can set us apart by the gray hair. I am on LinkedIn. You can find me there, Facebook, as well as my website, formynder.com. That's the number 4, myndr.com. And yeah, those are probably the 3 main places to reach out.
Well, it's always, always, always a pleasure to talk with you, Omen. Thanks for joining us today.
Appreciate you having me on the show.
Take care, everybody.
To get transcripts, show notes, or more information, go to operationretirementreadiness.com. Have a question or topic for the podcast? Send it to info@operationretirementreadiness.com. Find out more about Amy and Mike at their websites. Mike is the founder of Next Mission Financial Planning, LLC. He retired from the U.S. Air Force and has worked in the financial services sector since 2021. He is a certified financial planner, chartered financial consultant, and a certified college financial consultant. You can find out more about Mike at nextmissionfinancialplanning.com. Amy is the founder of Instar Financial Planning, LLC. She is retired from the U.S. Army and has worked in the financial services sector since 2019. She's a certified financial planner, a chartered federal employee benefits counselor, and a chartered retirement planning counselor. You can find out more about Amy at instarfp.com.